Hi everyone, thank you for joining me today. In today's video, I would like to discuss negative interest rates. I want to discuss what are negative interest rates, what are the implications, are they bad, and what can be some of the drivers of negative interest rates. So, what are negative interest rates? Quite simply, negative interest rates are banks charging the interest rate on depositors in order to hold their cash within the bank. So instead of a bank paying out an interest rate for depositors to deposit their cash within the bank, their assets within the bank is going to receive cash from the depositors. So that is what negative interest rates is in a nutshell. And now there are currently certain countries that are charging negative interest rates by the central bank, and this includes Japan, Denmark, Sweden, and there are a few other central banks charging this. Now there are some folks that are concerned about these negative interest rates and feel like that these negative interest rates are a horrible thing for a central bank to push on the market. But that's not necessarily true in of itself. Negative interest rates are not inherently bad by itself, depending on whether the market forces are driving these negative interest rates. If the market forces are driving negative interest rates, then that is purely the market deciding that they would like negative interest rates on these deposits held by the bank. And you would be able to tell whether or not the market forces are driving these interest rates by monitoring the inflation rates being experienced by these countries charging the negative interest rates. So if there is a low level of inflation and inflation is not really upticking to any great degree, then that is evidence. It lends credibility to market forces being the driver of the negative interest rates, and the negative interest rates actually being the accurate market-driven rate that the banks should be pursuing. On the other hand, if inflation begins to uptick and begins to move into hyperinflation, or even before hyperinflation, that would be evidence that market forces are not driving negative interest rates, and that is an artificial environment. So what can cause negative interest rates? Well, to understand this, you need to understand a couple of macroeconomic principles. You need to understand inflation and deflation, and you need to understand the Fisher equation. The Fisher equation is the equation of what determines the nominal interest rates that we are able to observe in markets. So first I'm going to begin by discussing inflation and deflation. So let's consider inflation first, since that is the environment that we are most familiar with. So what is inflation? Well, inflation, quite simply, is the increase in price levels over time. So to give you an example of inflation, if you have $100 today, and what you can buy with $100 today is going to be a lot more compared to what you can buy with $100 tomorrow. So let's spin this around and apply this example in the terms of loans. So if you take out a $100 loan today and you're going to pay back the loan in $100 in tomorrow, you're actually paying back the loan when discounted to today's value, it's going to be less than the $100 you paid today. So that is what inflation is. Inflation is good for folks who are taking out loans because it decreases the amount that they have to pay back. Now, to go to the flip side of inflation, which is deflation, which is essentially the opposite of inflation. Deflation is the decrease of the price level over time. So what $100 is worth today, what you can buy with $100 today, is less than what you can purchase with $100 tomorrow. So to apply this concept to loans once again, if you are taking out a loan with $100 today, and you're paying $100 for the loan in the future to pay back the loan, you are actually going to be paying back more than, when you discount it back to today's value, the loan payback is going to be more than what you originally took it out. So in a deflationary environment, loans are actually, deflation is actually works to the disadvantage of folks who are taking out loans, because they actually have to pay more back compared to in a inflationary environment. So now, to move on to the next concept that we need to understand in order to be able to understand the entire negative interest rate environment, I'm going to discuss the Fisher equation. And what the Fisher equation is, it identifies the components of the nominal interest rate that we are able to observe in the markets. So now the nominal interest rate is made up of two components per the Fisher equation, and this is the real interest rate and the real interest rate and the inflationary rate, the inflation or deflation component. So now, so typically you'll have the real interest rate and you'll have the inflationary rate, and that combined together, aggregated together, will give you the nominal interest rates that you are able to observe in markets. But now in a deflationary market, that other side of the equation, so there's your real interest rate and your nominal interest rate, well, not your nominal interest rate, your inflationary rate. The inflation rate, part of the component of the equation, in a deflationary environment can be negative. And if that negative is greater than the real interest rate, the nominal interest rate can come out to be a negative interest rate. So that would be market forces that are driving a negative interest rates. An artificial negative interest rate would be an environment where the two components of the two factors of the equation, the real interest rate and the inflation rate, does not sum into a negative rate. And countries may decide, and central banks may decide to take this approach and this strategy in order to attempt to incentivize their economy, to encourage their economy to grow and to increase investment demand. And this would be, and you would be able to tell the difference. You would be able to identify the difference between an artificial negative interest rate and a market-driven interest rate by monitoring the inflation rate within an economy. And if the inflation rate within the economy is ticking up, then you can tell that that the negative interest rate is due to artificial pressures by the central bank. So, to recap very quickly, negative interest rates are interest rates charged on depositors by banks to hold their assets. The implications of a negative interest rate is not necessarily bad in and of itself, but it can be a signal of the economy not doing so great overall. It could be a signal of deflationary pressures, or it can be a signal of an artificial environment. And how you would be able to identify these two things is by keeping an eye out on the inflation rate and monitoring the inflation rate to see if it is increasing in tangent with or together with the inflation rate. All right, that's all I have to say about negative interest rates today. Thank you for joining me today. Have a great day.